Tom Bowley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, December 3rd, 2024 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and it's a pleasure to be with you this morning. Yesterday, we had a pretty decent day in the market. We'll go over those numbers in just a second. But it was a little bifurcated. Small caps gave back just a little bit, or small caps and mid caps kind of struggled a little bit. They rallied in the afternoon, then they gave a little bit back. But again, we'll go over those numbers in just a minute. 10-year Treasury yield has been working its way back down. As we talked about recently, we had a negative divergence on the TNX, and that has made its way almost all the way back down now to the 50-day moving average. Kind of figured we'd move back to that 4.10 to 4.20 area. I think we finished right in that range here the last couple of days, been testing that range. So I think that's kind of gone along as expected. Again, we'll look at that chart in just a couple minutes as well. I continue to pay attention to the small caps, even though they did lag a little bit yesterday. I see the Fed continuing to lower rates as we go into 2025. And when we talk about lowering rates, we're talking about the short-term rates. And those are the rates where small and mid-cap banks, they borrow at those rates. So they borrow from other banks, they borrow from the Fed. And so as that short-term Fed funds rate drops, it actually makes it more manageable for these smaller banks, mid-cap banks, to access capital to borrow. Their borrowing costs go down. And then when they lend that money out, as they make more and more money and that spread starts to widen in terms of their interest margin, they will lend more. And that in turn helps to boost the economy for many of the smaller and mid-sized companies. So that's what I was calling for back at the beginning of the year. Took a little while for the Fed to get started cutting rates, but really since about the July, maybe the second week of July, we've been seeing outperformance by small caps. And I think it continues and possibly even accelerates into 2025. So that's what I'm looking for there. Anyhow, let's go ahead and take a look at the action from Monday. This, by the way, is a pretty good week for the market historically. But then we do have to kind of be a little careful as we move forward. I'll be talking more and more about that with members in our daily market report. I also pointed it out in the weekly market report yesterday. If you didn't already look at it, take a look at the area where I provide the upcoming 2 weeks annualized returns by day on the S&P 500, the NASDAQ, and the Russell 2000. We have a clear period coming up where all three of those indices tend to pull back and sell off for a bit. So that's right around the corner. Make sure you check that out. As far as yesterday goes, though, Dow Jones Industrial Average finished down about 0.3%, but the S&P 500 was up about 0.25%. So again, there's some of your bifurcation in the market. NASDAQ had a pretty good day. We haven't seen the NASDAQ outperform much of late, and we're going to see it periodically. I mean, there's still, even though I favor small caps, you got a lot of companies in the NASDAQ 100 that are still doing extremely well. I think the rotation is just showing that investors are maybe a little bit more interested in areas that they feel can move faster. We've seen a huge run up in the NASDAQ 100, not so much of late, but I'm talking about earlier in 2024 and in 2023. And that asset class just became bloated, in my opinion. Very similar to what we talked about with the semiconductors back in June, that they had gone up 133% in 7.5 months. That's unsustainable. I don't care how much you like semiconductors. I don't care how much you like NVIDIA. That is just an unsustainable advance. You can't keep going up at that rate. And it's okay for the market. And in fact, it's bullish for the market to settle down in those areas, rotate a little bit, and let the money flow into other areas of the market. Where it would be bearish is if the money came out of those areas and it didn't find a home anywhere else, and the money just left the market. Then we would start to see the major indices roll over and perhaps move into more of like a correction or just some short-term pullback. We haven't really seen much of that yet. Money just keeps rotating from one area to another. So it's hard to bet against the stock market when a secular bull market advance is underway, because the hallmark is rotation. And that's exactly what we've seen. So I think some of the defensive areas could lead here in December. Historically, that's not unusual. It's the third calendar month out of the calendar quarter. Those months, March, June, September, December, tend to favor more income-oriented areas of the market. So we need to keep that in mind as we go throughout this month. I would not take rotation into staples and healthcare and other areas necessarily as bearish. We'll have to see. I mean, there's other signals out there that we need to watch. And when I talk about outperformance, we had back in 2021, consumer staples outperformed consumer discretionary by 10 percentage points. That's a lot. And coming on the heels of a lot of warning signs, it was just one more warning sign that made us believe that we were going into a cyclical bear market, or at least that the odds were increasing significantly that we would see a cyclical bear market in 2022, which is what we saw. Not really, it's not similar. The market, in my opinion, is not set up anything like it was back in 2021. So I'm not concerned at this point about some kind of an impending, correction or cyclical bear market. I think any kind of a pullback will be contained. I think we see new highs by the end of the year. And this is what we were talking about all year. We thought we would finish over 6,000 or potentially over 6,000. And by the way, that was later in the year. My prediction back at the beginning of the year was not that bullish. It was probably as bullish as anybody on Wall Street, but it was not expecting 6,000. Anyhow, later in the year, though, as we did make our way up into the mid 5,500, 5,600 range on the S&P 500, I did start talking more about 6,000 in the fourth quarter, which is where we are now. I wouldn't be surprised if we finish 6,200, 6,300 by the end of the year. But we do have an upcoming period that we have to be careful with. So again, members, check out that weekly market report from yesterday, and you'll see exactly what I'm talking about. All right, let's keep moving on. I want to talk a little bit about the 10-year Treasury yield. Here is what we were talking about earlier. We were moving up on the yield, but look at the PPO start to roll over at the most recent high. So we had challenged that 450 level, and as we started to roll over, we talked about a reset. Notice how since back in late September, the yield's been trading above the 20-day EMA. Well, when you get a negative divergence, you start looking at maybe that 50-day SMA as a possible reset. Look at where the PPO is now, resetting at the zero line. Now we've got the 10-year Treasury yield just down below 420, sitting at 417.6. Let me get the latest, 417.8 right now, so about 4.18%. But that's right on the 50-day. 50-day moving average right now is 4.17. So effectively, that negative divergence is now what I refer to as played out. The PPO is reset. We're at the zero line. There's no momentum. So I think the 10-year Treasury yield right now is free to go whichever way it wants. Maybe it move back toward 450. If it breaks below the 50-day moving average, we could bring 360 back into play. Would not surprise me at all. In fact, I think with rates coming down, short-term rates coming down, and with inflation expectations continuing to move lower and lower, I do think the 10-year Treasury yield will ultimately make its way back, perhaps down to that 350, 360 area. I think that could happen in 2025. Maybe it happens in January of 2025. I don't know. But all I'm saying here is based on the daily chart right now, we've got a reset. I think the 10-year Treasury yield could go anywhere. I don't believe we're going back up above 5%, which was the high we saw over a year ago. I don't believe we're going to go back down below, say, 3%. I think we're going to be in a range for a while. But that'll be a good thing. The 10-year Treasury yield stays in that range. That's still historically a very low interest rate, and an interest rate where the economy will have plenty of room to grow. That, combined with the short-term rates coming down, is going to uninvert the yield, and that is going to be a boon for small and mid-cap stocks, in my opinion, and the small cap and mid-cap stocks in general as we go throughout 2025. Sectors yesterday. So we had technology leading yesterday. We haven't seen that much of late, which is fine. Consumer discretionary, communication services. Those were the only three areas up yesterday. Does that sound familiar? because that sounds like the first half of 2023, or excuse me, 2024, and back in 2023. We saw a lot of leadership from these groups, especially technology and communication services. Consumer discretionary playing catch up, which is a really good sign in my opinion too. I love to see the discretionary stocks going up, because if you just think about it, consumer discretionary and consumer staples. Consumer discretionary are all the companies that sell us the things we want. Consumer staples, those are the companies that sell us the things we need. Big difference, want versus need. We're always going to buy the things we need. At least I hope so. I hope you buy toothbrush no matter what's going on, or toothpaste, no matter what's going on with the economy. I hope you're buying toothpaste and deodorant and soap, keeping yourself clean. That would be nice. But you see that all the time. What you don't see all the time is when the economy starts to retreat and possibly even head toward a recession, a lot of those wants that we have, we don't buy. And so many of those consumer discretionary companies begin to take a big hit when the consumer doesn't buy the things that they want. And so watching that relationship between those two sectors, I don't know if there's anything else. I don't know if there's another secondary indicator that's more important, at least not one that I can think of for me, than the relationship between consumer discretionary and consumer staple stocks. I believe when that ratio is moving up, that's a very, very bullish development for stocks. And I think we should expect that any kind of market rally is sustainable and that we'll continue to push further and further to the upside. But anyway, consumer discretionary, you can see up about 8, almost 9/10%. And if you look at consumer staples, down 1/10%. So that relationship right there is very strong and remains strong and has been strong for a while. So I'll continue to watch that. But for now, that's giving a green light in the market. Now, down toward the bottom, you'll see some of those defensive groups. I actually think some of these groups could pick up, like I said earlier in the show. I wouldn't be surprised to see a pushback to the upside in some of these areas as we head toward the end of the year. Once we get into January, though, typically, historically, we see money move over more toward communication services. Technology starts to get a little bit more of a queue, a buying queue. And normally we're going to see those aggressive sectors lead in the month of January. And January, by the way, is the best performing month of the year for the NASDAQ. So not so much for the S&P, but for the NASDAQ. So we got another month, I think, of this bridge until maybe we start heading back more towards some of the large cap names. But I don't think it's going to be like it was in 2023 and 2024. I really don't think these are the groups that are going to lead. I think the asset class that leads is going to be small caps. And I'm sticking with that for now. All right, let's take a look at, I wanted to bring up the PSCD. This is the Invesco S&P Small Cap Consumer Discretionary ETF. So you can see it's mostly gone sideways, but since about the middle part of the year, maybe around July, I think it started to move more in an uptrend. And we did just get a recent breakout. Now this PSCD, I'm not looking at it to trade. I mean, look at the volume on it, right? It normally trades probably 1,000 shares a day or something. I mean, it's not very liquid, but it has a basket of small cap stocks, and we can still look at the value to see whether or not that basket is going up or not. And here you can see the PSCD is moving up. It's just recently broken out to a new high in 2024, and that's good. If we take a look at small cap, I want to show you small cap growth versus small cap value. And I'm going to put this into a solid line as opposed to candlesticks. Then I'll just get rid of some of the noise and switch out the AD line for the RSI. And then take a look at this. And so what we're seeing now is this move up in the early part of November, second week in November. That high actually cleared the high that we saw back in June. So we're now looking, well, at least based on that, that had pushed us to about an 7-8 month high, relative high. In the small cap area, looking at growth versus value. So while we've talked about value stocks overall doing better in the market, and I'm talking about the S&P 500 among the large cap names, small cap, you can see that there's been some money pouring in to some of these small cap growth names. So think about software, some of the small cap software stocks. We have, I think, 3 of those in our aggressive portfolio. I think we probably, I don't know if we had small cap. I think we had mid cap or large cap software in our model portfolio. I know we have Palantir. But anyway, we have some smaller companies in our aggressive portfolio, and this is exactly what we're trying to ride. We're trying to ride this wave because I believe this is going to go higher and higher throughout 2025, eclipsing the highs that we saw back in early 2024. And if we go back a ways on this chart, let's just do it this way. And if we go back 5 years or so, this hasn't been a great area of the market. And this is what a lot of folks get wrong about the stock market. They have recency bias. So if small caps haven't worked for the last 2 or 3 years, they don't want to touch them. Well, the problem is the environment is changing. As I mentioned, short-term interest rates are coming down. That is benefiting small and regional stocks, small bank stocks. You can look at like the KRE. Let me pull up the KRE here. So the KRE, look at what's been going on here in the banks. There was anticipation of rate cuts, and then the July, or it was actually June CPI. When the June CPI report came out, that's when small caps exploded over a 2-week period versus the large cap stocks. The IWM outperformed the QQQ by 18 percentage points in 2 weeks when that report came out. Then we gave back a little bit, profit taking. Folks kind of forgot about things. Well, when the actual rate cuts started coming, look what happens. We're just getting started, these rate cuts. And I think we're just getting started on this advance in the KRE. Now, the KRE is the first area of small caps to benefit. But once they start benefiting, making more money, they're going to lend more. And that, I think, is what the market is anticipating right now, which is why IWM and mid caps and so forth are moving back up again. Wall Street doesn't wait until the earnings reports come out. Wall Street projects what's going to happen over the next 6 to 9 months and starts to build it in now. So if you're looking for, great reports or great growth currently, you're going to probably be disappointed in a lot of areas of small caps. But in another 3 to 6 months, I don't think you're going to be disappointed. And that's why these stocks are being bid up. And the reason why we need to be ahead of the curve and be a part of this before we have the huge run. Anyhow, just a little bit of an explanation there. Healthcare. I talked about healthcare. It wasn't actually, I think it was a week or 2 ago. I think it was 2 weeks ago that I said we were about ready for a move in the healthcare area. And the reason I said that was if you look at a 5-week chart, and I'll annotate this. If we take a look, and just put in this price support resistance line, you can see the tops that we had back in late 2021, early 2022. And then, of course, XLV held up better than other areas. I mean, we went into that cyclical bear market, remember? Well, by the end of 2022, healthcare was back up near the high because defensive areas don't normally get hit as hard during a bear market, but they also underperformed during a bull market. So the bull market's taking off in 2023. Healthcare couldn't break out. Finally, rising tide lifts all boats. Bull market usually sees wide participation. And as a result, in early 2024, we finally got the breakout in healthcare. That level came at, or that breakout came at the 137 level on the XLV. Went back down, tested 137 up to a new high. And as we were coming back down, this is why I mentioned this 2 weeks ago, we were getting really close to a key support level on the XLV. I mean, is the healthcare group the best sector out there to invest in? I don't think so. But from a risk to reward perspective, it was getting very close to a key support level, and therefore I was looking for a rebound. Now, we didn't get down. We didn't test 137, but the range is 137 up to almost 160. That was where we saw the recent high. So when you get down to 140, I mean, you can hold out for $3 more if you want, but I think it's time to start accumulating when you get down close to a support level and you have resistance that's so far up there. I mean, if we were to buy in the 140s and it ultimately gets to 137, you can add. You can bring your cost level down. But I think getting in and starting to build a position in healthcare made a lot of sense to me 2 weeks ago. We're starting to see that move. We may fail at the 20. We might come back down one more time. Maybe we still go to 137. But I believe that 137 to 140 area is a good long-term entry point into healthcare. All right. I want to mention, first of all, our fall special. You can actually, if you go to our homepage, which is just earnings beats, you'll see a couple of things. First, we do have our fall special. It was very popular. We had a lot of folks extending. By the way, about 90%, maybe more, of our paying subscribers at Earnings Beats are annual members. And it's because we give so much of a break in terms of the membership cost. So being an annual member costs maybe a little bit more than half of being a monthly member and paying 12 months monthly. So if you like the service, it absolutely makes sense to buy into the annual membership. Well, right now you can see if you can save 20% on an annual plan plus get 2 bonus months. So the deals don't get much better than this one. And like I said, it's been very popular. It was due to expire on Sunday. We extended it for 2 more days, which takes you through today, Tuesday, December 3rd. You've got until midnight to sign up under this deal. You can click on that and it'll take you to a page where you get more information. But I want to just bring your attention to what I always like to bring your attention to, which is our Earnings Beats Digest newsletter. This is completely free, no credit card. You can unsubscribe at any time. This is where we just like to give back to our community. Got a lot of folks that watch us on YouTube, a lot of folks that follow us through our EB Digest, a lot of folks that follow me over at Stock Charts when I write my blog article. But anyway, anybody can sign up for this. And like I said, no credit card required. All you need is your name and email address. We'll send you a couple charts every week, Monday and Wednesday, just showing you how we approach the market. It's more of a detailed kind of an analysis of one stock or one ratio or one sentiment reading, something to help you deal with the market and learn a little bit more about the market. I think if you take some of the things that we teach and talk about and add it to your own strategy and your own style, I think you're probably going to find that you're going to have better results in your trading. So anyway, if you go over to earningsbeats.com, that's our name, earningsbeats, both plural, .com, and then simply scroll down, sign up for this free newsletter. The EB Digest article that I sent out yesterday on Monday, this is the chart I sent out yesterday. This is Hyatt hotels. Now, hotels tend to do pretty well. Let me show you the seasonality. We'll come back to this chart in just a second. Let me show you the seasonality for Hyatt hotels. And right now it's the default for 5 years. I'm going to go back 12 years, which is the length of this current secular bull market. And I want you to look from October to February at these annual returns, or excuse me, the average returns for each month. October 2.6, November 6.5, December 3.5, January minus 1.1, and then February 7.4. But if you add October, November, December, January, and February coming across here, that's going to be 12.6, 11.5. That's 18.9%. That's the average return on Hyatt from October through February, 18.9%. If you add up all the rest of these for the year, I don't remember what it was, but I want to say it's like minus 1.5%, something like that. Maybe it's more than that. But my point is This is a historical sweet spot, a seasonal sweet spot for hotels in in particular. But if we want to be really specific and just go down to the individual stock, Hyatt loves these 5 months. So with that in mind, let's go back and take a look at the chart. Now here on the chart with Hyatt, you can see we had a high in March that was just above 160. Then we had a high in July that went up to about 162. We had a high in September, 160. And then we had 2 more highs in November, just above 160. So I think it should be pretty clear. And if it's not, let me just highlight this. But if we just start like right here and draw this right across, oops. There is pretty clear resistance. I think everybody should be able to see that. All these tops right here. This is a long base. Hyatt's been basing a long time. Now, since the end of September, so October, November, we're up a little bit. But the average from October to February is about 18.5%. And right now, we're probably up, I don't know, since actually from here, which was the end of September, that was 152. We're probably up maybe 2%, 3%. So it kind of makes sense that if we make this breakout, watch for volume, make sure the volume confirms. But if we make this breakout and get through 162.50 and the volume starting to pick up, knowing what we know seasonally, I mean, I don't know why we wouldn't be interested in a stock like Hyatt. And this is what we do with our EB Digest. We just try to give things, give some folks things to think about, and maybe trade. I mean, obviously, if you trade, that's your risk, not ours. We're not registered investment advisors. I'm not advising. I'm not recommending. I'm just educating. And so if you decide to take on the position, just make sure you manage your risk. If you make the breakout, you shouldn't go back down below the 20-day moving average. So if I were to get into this stock on a breakout, I would definitely have a closing stop set around 155. No reason to go back down and close below the 20-day if you're breaking out after a long basing period. But anyway, I think this one looks pretty good. Now, the other thing I wanted to point out here too was market cap. This is a mid-cap stock, $15 billion market cap. So it kind of fits into the theme of the small and mid-cap stocks. It has the seasonality that we want to help support us to the upside. Now, all we do is we're sitting here waiting for a breakout. Now, you can get in before the breakout, which obviously, if it does break out, makes you more money. But there's no guarantee we're breaking out. We've been up to this 160, 162 level. As I showed, it was probably 5 times. Let me see. Almost over here. So count it 1, 2, 3, 4, 5, 6, 7. 7 times we've been up to this 160 area and into this zone or close to this zone without breaking through. So you can make the assumption it's going through, but I'm just telling you 7 times we've tried and haven't gotten through yet. There's no guarantee we get through. But if we do get through, then we've got the seasonality to back us for the next couple months, next few months, which I find pretty bullish. Anyhow, let's see. Before we wrap up, let's take a look at a couple of stocks that reported earnings yesterday. Zscaler actually came in with a nice report on the bottom line, 77 cents versus 63 cents. So that was a 22% surprise to the upside in earnings. Let me see if I can get the sales on that for you too. Zscaler beat by, it was almost a 4% positive surprise on revenues. So revenues came in 628 million versus 606 million. And all of that, you know what that got you? 6% decline in the stock down to 195.60. So then we pull up the chart on ZS. So they beat top, they beat bottom line. I like that. And now the stock's back down to around 195. I actually think down here around the 50-day moving average, somewhere between this gap support, but I would just say the 50-day moving average. I mean, if it gets down to 190, 191, that probably would be an interesting area to consider buying. And what I would do is wait and look at the 10-minute 5-day chart. And you can see sometimes in the morning, you go down, down, down. And then once you start to reverse and come back up, that can be a sign to buy. But especially in this situation, because for me, again, when I've got a stock that's beaten top line, beaten bottom line, I already feel better about it. It's a stock that was in an uptrend. You can see it's been trending higher since the triple bottom, back down around the 155 level. Recently took out these tops. And so I think the stock's going to recover after it goes back down. AD line's been pretty strong. Let's pull up the relative strength because I have a feeling this one might be lagging a little bit, relative strength. Yeah, versus software, it's still not quite. I mean, I'd love to see a breakout, but we're going to see another drop at the open there it is. It's dropped down there. It opened at 196 already at 199.67, but I'd be careful. It could be very, very volatile at the very open. Wouldn't be surprised if it were to turn back down again. It's already back down 197. But here you can see this is the start to the downside. Maybe we get some more weakness till 10, 10:30, 11 o'clock this morning. Maybe we see that 190 level or 180s and then start to reverse. That would be a potential trade, an intraday trade for me. But again, that's, I've done this for a long time. I would be careful, maybe take small positions if you're not normally trading in this manner. But yeah, I think Zscaler is one that on a further pullback, we could be looking at some decent action later. How about, let's see, CLSK, Clean Spark. This is one that's been crazy at times with the volatility to the upside and the downside. The stock did miss on its revenues. Earnings, it missed on its earnings as well. So this one I'm not quite as excited about, although it's going to try to hold on to support right around that 13 level. If it doesn't hold there, then it can look down to gap support. Looks like just below 12, which is also right where the 50-day moving average is. So that's a couple levels to look at there. Today's earnings, just want to point out, first of all, that after the bell, Salesforce.com will be reporting. So let's take a look. I'm just going to look at a couple of these stocks real quick. Salesforce, on a relative basis, oops, thought I had it. Excuse me. AD line looks good. Price action looks good. Relative strength looks good. It's pulled back. I mean, I wouldn't be surprised to see gap up on Salesforce tomorrow. I like these kinds of setups. I mean, I think we've got A, B, C, potentially D. Looks to me like we got an A, B, C, D as part of a A, B, C, D, E ascending triangle pattern. And you hit that E with a breakout. So if this pattern holds up, I'd be looking for a move maybe up $20 tomorrow at the open from where we are right now. I wouldn't be surprised. Now, it's definitely not a guarantee, but the stock has been a leader. It's relative strength. It's been, kind of off the charts, moving higher. That's been going on since all the way back in June. So all the way throughout this last quarter, we saw very, very strong relative price action in a group that was strengthening. But here's software. Software had kind of put in this double bottom here, but over the last 6-7 weeks, we've been strengthening, and this has been a pretty solid group within a strengthening area of the market. So I wouldn't be surprised to see good news. Now, of course, we know what can happen with good news. I just showed you with Zscaler. Top and bottom line beat, and stock still gapped down. So, there's nothing we can do to guarantee anything with earnings. Earnings is going to be very volatile. It's going to be very risky. If you're going to hold any stock into earnings, you have to understand the risk you're taking. Now, I would consider it number one because this is a very good, solid, long-term stock. Salesforce.com. It's not a company I've never heard of. I would be less tempted to hold a stock into earnings that I don't really know much about, or has one of these long-term charts like this. You look at, Salesforce over the long haul, go back 15 years, and you can see it's a pretty steady grower. Just made a big breakout here, in my opinion, above what looks like a long-term cup handle down to the 20-month and a breakout. This measures, by the way, probably up to about close to 500, 475 maybe. So a lot of good things look, on this chart that would lead me to at least think that maybe taking the risk is worth it based on the potential reward. But again, that's a personal decision. Everybody has to come up with that one on their own. Couple others that will report tonight. Pure Storage, PSTG, just looking at this on a relative basis. Now this one down near a 52-week low, I wouldn't touch it. I just don't. That's just a quick no touch for me. Okta, OKTA, another software company, AD line weak. Price action's been very weak. There's probably a reason. AD or the relative strength horrible. I would be careful on a stock like this. And maybe we'll just end it there. Well, we'll do one more. How about Box, BOX? So Box has been trending up. AD line not really supporting it though, been moving down. Relative strength is pretty strong, again, among software stocks. We got the breakout. We pulled back. Kind of got some mixed feelings about this one, but if I had to hold into earnings, I would probably be on the long side, despite the weak AD line. I like the relative strength. I like the recent breakouts. So I wouldn't be surprised to see it move higher with some strong numbers. Anyhow, let's get a quick update on the market, see where we are right now, and then we'll wrap this thing up. So right now we got the Dow Jones down less than 0.1%, S&P 500 flat, NASDAQ flat, small caps down just fractionally, pretty much flat as well. So pretty doing nothing kind of an open so far for the market. We'll see where we go. Again, the tendency this week is for the market to kind of push a little bit to the upside. But then we're getting closer and closer to a time period when you do really have to be careful about the market. So anyhow, just be careful out there as we move into the middle part of December. Anyway, that's it for me. Have a great day, everybody. Members, I'll be back this week. We didn't do it last week because of Thanksgiving week. But I'll be back tomorrow morning at 10 a.m. for a live trading room. Anybody who wants to join that, if you go over to Earnings Beats, by the way, just use that special up above. You can sign up as an annual member, but you can just start a no-cost 30-day trial if you want, and also come into the trading room. You'll get the next 5 Wednesdays free. Well, there might not be 5 because of the holidays. We'll have to look at the schedule. But you'll get a number of live trading rooms as part of your no-cost trial. Anyhow, that's it. Everybody have a great day. Like I said, I'll be back tomorrow for the live trading room, and I'll be here next Tuesday for the next Trading Places Live. Have a great week, everybody. Happy trading.